continue chapter 2, time value of money. And we go to 2.8. We apply the concept time value of money to do bond valuation. Okay, first of all, let's review a little bit about what is a bond and the characteristic of a bond. Okay, so a bond is a type of fixed income security, chứng khoán có thu nhập cố định. Yeah, and when you buy a bond, you place the role of the lender. So you lend your money to the issuer. Yeah, the issuer can be government or can be corporations that they in return, yeah, they pay you two things. The first cash flow is the coupon payment. Yeah, the coupon payment will make, you know, at the usually at the semi-annual frequency or annual frequency. And then by the end of the bond life or at the time to maturity, they will return the face value. Yeah, you will get the refund of the principal or the face value of the bond. Okay. Okay, please make sure that you are familiar with some terminology like coupon, cổ phiếu, face value, mệnh giá, coupon rate, lãi cổ phiếu, maturity, thời gian đáo hạn, and yield to maturity, or YTM, chúng ta hay gọi là YTM ha, lợi suất đáo hạn. So they are the information, the factors in the bond valuation model. Okay, let's see one example. Okay, suppose that I have a bond with the following characteristic. They have face value, mệnh giá, or we say par value. Yeah, par value, the same meaning. Yeah, and this is M. Yeah, standard abbreviation is M. Is $100. Yeah. Coupon rate, lãi suất cổ phiếu 6%. Yeah. And time to maturity, yeah, it's D, for example, 3 years. And frequency of payment, coupon payment. N equal to, for example, one mean one time per year. And what else? Okay, and then we have the discount rate, Y or YTM, huh? The discount rate. Yeah, YTM is, for example, 9%. Yeah. Okay, so if you hold this bond, so what will be the cash flow of this bond? What do you receive? What is your cash flow? Yeah. Okay, I'm going to draw the timeline, the cash flow of the bond. 0, 1, 2, and 3. Yeah, and this is 3 year correspond to the time to maturity of the bond. And because the frequency of coupon payment is one time per year, so we have 3 payments. Yeah, so the timeline is from 0 to 3. And from the face value and the coupon rate, I can calculate the coupon C. Yeah, equal to 1 face value multiply for 6%. Yeah, equal to $6. Yeah, $6. So it means every year you receive the coupon payment of $6 per year, and then by the end of year three, you get back the face value. Yeah, okay, and that's it. That's all. That is your the inflow, the cash flow, the inflows from the perspective of the bond investor. Yeah. So now the question is, how much will you pay to buy this bond, to have this bond, to own this bond? Yeah. So that is the question of the present value of the cash flow, right? Yeah. So basically the principal evaluation of any assets that generate cash flow is you discount all the future cash flow to to present, to where you are, yeah, to where you want. So usually it is present, yeah, and then that's it the value you should pay to all that assets. Does that make sense? Yeah, you don't pay more than the value of the cash flow it can generate for you, yeah, and the seller doesn't want to sell at the price that less than the value of the cap of the future cash flow. Okay, so BV, yeah, you can write down yourself. Yeah, so yeah, that is the price of the bond valuation. Very simple, isn't it? Okay, and now I will change a little bit. Now, what if the company that pay coupon semi-annual, mean every 6 months they pay coupon. Yeah. So here now we have n equal to 2. That is the frequency of coupon payment. 2 times per year, n equal to 2. So how does your cash flow look like? Now if they pay 2 times per year and you have 3 years, it means that in total you have 6 payments. 6 times you get the payment. Yeah. So our timeline will extend to 6. But remember that 6 months, yeah, one period is 6 months, but generally is still 3 years. Yeah. And then every period, how much do you receive? How much coupon do you receive? So every year you receive $6. Yeah. But then for half year, when n equal to 2, then you receive coupon is 6 divided by 2. Yeah, $6 per year. And then now we have $3 for half year. Make sense? Okay, but $3 here, $3 here. Yeah, but one thing doesn't change. That is the face value. You always get back the same face value by the end of life of the bond's life or at the maturity date. Yeah, $100. This is what you get back in period 6. Okay, and now we can write down the BB. Yeah, you can write out yourself, please. Okay, wait. Now I cannot write 9%. Yeah, because 9% is 9% per year. Agree? Yeah, but our cash flow and our time, our the interval, one period here correspond to 6 months, half year. So 9% here I had to adjust for number of frequency, for the frequency of coupon payment. Yeah, so I divided by 2 in order to get the discount rate for 6 months. Yeah, and the second period, yeah, and I do the same for the rest, and then I write out like this. Yeah, power 6. Yeah, power 6. So that is the value of the bond. Okay. Okay, now I have a general formula for this. Here you are. Yeah. And here you have, okay, N is the number of coupon payments per year and T is the number of years to maturity. Yeah. Okay, but imagine if, okay, usually the bond is long term. Yeah. For example, if you have a bond that time to maturity is 20 years, imagine for 20 years. And if you write a formula BV for 20 years to discount all the cash flow of the 20 years, it's a lot. Yeah. So please pay attention to this. Do you see this cash flow? Yeah. The cash flow are identical. And the cash flow are identical too, right? They are the same every period. So we call them annuities. So you know about annuity in the previous lesson, right? Yeah. So now we can use the annuity formula. Annuity formula is simply the reduced form of the general formula. We write it like a special case, yeah, where the cash flow or the amount of money are equal across periods. Yeah, so we can write in a short version. Yeah. So for example, this one, I can write like this. Can you do it? Can you write as the annuity formula? Yeah. Do you remember annuity formula? Annuity formula is BV of the sequence of cash flow. Yeah. Yeah. That is the BV of the cash flow of the annuity. Okay, and now we have $3 here. Yeah. This is the number 2. Power 6. Yeah. And then we still have, but this is only the BV of the coupon rate, of the coupon payment. We still have the face value. Yeah. So in other words, this is what I did. I write down. I write the formula, the short version of this cash flow. Yeah, of this cash flow. But we still have $100 here. We still have $100 here. Yeah. Remember. Okay. $100, the face value doesn't belong to the annuity. Yeah. Okay. Zero coupon bond means the bond that pay no coupon. No coupon. No coupon means C is equal to 0. Yeah. I'm sorry. The whole yeah is 0. And then we only have this one left, right? Yeah. So this is the formula for zero coupon bond. And for the bond that pay coupon only, mean they don't pay the maturity, they don't pay the face value. If they don't pay the face value, then the face value is this one doesn't exist. Yeah, so we only have this. This is the formula. Yeah. And a perpetuity bond that the bond pay. Okay, and a perpetuity bond means the bond that pay only coupon. It's never pay the face value. And the specialty is this coupon they pay forever. So they now stop now. They now define maturity of this coupon payment. Okay, so if this Okay, no face value. And then if this d goes to infinity, it means the whole denominator become very large, right? And then 1 divided for a very large number, then this ratio become very small and close to 0. Yeah, and 1 subtract for 0, then equal to 1. So the whole factor here equal to 1. So this is what we get. P equal to C divided for Y over N. Yes, so this is the formula for perpetuity bond, trái phiếu vĩnh viễn ha. Okay, now take a look at one example. This is 10 years. Yeah. Due to maturity, YTM is 10%. Yeah. And it pay $80. Yeah. For the next 10 years. And it say it pay annual coupon. So it means it pay one time per year. And the face value M equal to 1,000. And the question is, would this bond sell for? Okay, then we write down the bond price formula. Yeah, and then we put on the number. Okay, please note that in your lecture note, this number, the YTM is 8% instead of 10%. Huh? Because it divided for 1, so I don't have to write the N here. 10 years. Okay, so please solve the equation for the value of the bond. Okay, and now we go to yield to maturity, YTM. So YTM is the rate implied by the current bond price. What does that mean? Lợi suất đáo hạn. Yeah, so in the market, when you go to the bond market, you always see the market value, the P. Yeah, and you know the face value, and you know the coupon rate or coupon payment. And you know the time to maturity of the bond. You also know the frequency of payment. Yeah, this information are available. Yeah, so from this information, but the only one information that will be available will be YTM. This one, YTM. This one had to be calculated. So from the price and from the information of the bond, you can find the YTM of the bond. That's why when you look at the market price of the bond, you know the YTM of the bond. That's why we say the rate implied by the current bond price. Okay, let's look at one example. Consider a bond with 10% annual coupon rate. So I write down C equal to 10%. And this one is annual coupon rate, so it multiply for face value. And face value is 1,000 here. 1,000. And the current price, 15 years to maturity. Yeah. And N is 1. And the current price. And the question is, will the yield be more or less than 10%? Yeah. So without calculation, are you able to tell me that whether the yield or YTM, will be more or less than 10%? So more or less than the coupon rate. Okay, look at this. And here, in this case, we have this B price smaller than the face value. Yeah. So look at this formula. What is the relationship between the price and the YTM here? Yeah. Okay. The YTM is the position is in denominator and the P. Yeah. So the higher the YTM, the lower the price, and vice versa. Right? Yeah, so that is the relationship between YTM and the P. And look at the C here. C. Yeah, C, the coupon. You take it, you calculate C from the coupon rate, right? So basically, this is what you earn as when you buy a bond from as coupon payment. Yeah, and this is what you discount, the rate you use to discount your coupon payment. Yeah, so if you earn what you earn is larger than what you discount, you get premium, right? What you earn is larger than what you discount, then you earn a premium. So in that case, when C, I say C percentage mean coupon rate, huh? In order to distinguish with C, coupon payment. So when the coupon rate larger than the YTM, we have a premium. Then the P is greater than face value. And vice versa. When you have C smaller than YTM, what does that mean? It means you earn less than what you discount. Yeah? So you have a discount. Then the P smaller than face value. That is the principle. Please bear that in mind. Yeah? Keep that in mind. Okay, so here we have the case P smaller than M mean the price, the bond is sold at a discount, right? Smaller than face value. So that's why we expect that the YTM will be larger than 10%, will be greater than the coupon rate. Okay, so are you able to compute the YTM? Okay, let's write down the bond formula. Yeah, power 15 plus 1000. Yeah, over 1 plus YTM 10% and power 15. Yeah, please solve the equation and you get the YTM is 11%. Yeah, so it's greater than 10%. Yeah. Okay, now we have another case. Yeah, the YTM with semi-annual coupon. Okay, let's summarize the question. Yeah, M is 1,000 and they say they pay semi-annual coupon, so we had to divide this number by 2. So this one means 50. D is 20 and is 2. And this is the price. Yeah, either YTM more or less than 10%. Without calculation, now we are able to tell the YTM is more or less than the coupon rate. Coupon rate is 10%. Yeah? And we say the price larger than the face value, 1,000. It means the bond is trading at a premium. And what does that mean? It implies that the YTM is smaller, less than the coupon rate. Okay, if you don't believe, then you can calculate. Okay, so please solve this equation and then you get the YTM is 8%. See, it's smaller than the coupon rate because the bond is selling at a premium. What that mean? This means you are earning at a rate that greater than the discount rate. Okay, now get yourself familiar with another terminology about the yield. Yield to maturity is YTM, lãi suất đáo hạn. Now we have current yield, lãi suất hiện hành ha. And this is the formula for the current yield. The current yield, you see, is equal to annual coupon over the price. Yeah. So this yield measure the percentage of your earning in the form of coupon. Yeah, only coupon. Okay, and the yield to maturity will be the sum of the current yield and the capital gain yield. So basically, the YTM I can broken the YTM into I can break the YTM into two parts. One is the coupon, it come from the coupon, and the other come from the price. Capital gain yield or loss is come from the difference in the price you bought and the price you sell. Okay. Okay, so the current yield here is 8.35%. What does that mean? It means that the percentage, your rate of return in the form of coupon only is 8.35%. But see, the YTM is only 8%. What does that mean? It means that the capital gain here is actually a loss. Yeah, it means the price now decreased compared to the price you bought. Okay. Okay, again, this is the relationship between the price and the yield to maturity, and this relationship is inverse. The higher the YTM, the lower the price, and vice versa. You can explain this from the real-life perspective. Imagine if you issue a bond with, like for example, 8% per year of coupon rate is 8%, yeah? But in the market interest rate is somewhere 10%, then your bond is not attractive at all, right? So you had to increase, the yield had to increase, or in other words, you had to lower the price. Yeah, in order to make your bond more attractive or more competitive with the market, and vice versa. Yeah, if the market interest rate is somewhere like 5%, and your bond is offering 8% coupon rate, then your bond is attractive. Yeah, many people don't want to buy your bond, so the bond price will increase. Mean why the yield decrease? Yeah, okay. Okay, please make sure that this one I already talked about it, so please make sure you understand and you keep this slide in mind, bear that in mind, okay?